Good morning and welcome to the class. The topic which we are going to study today is about the cash flow statement. It's a subject the subject which we are covering is financial accounting and analysis. Today we will talk about the cash flow statement. I, Dr. Meenu Balian, would be taking you on a tour of the cash flow statement. So, the very first thing before starting the cash flow statement is that what is cash flow statement? See, there are three terms. One is cash, second one is flow and the third one is statement. So, we will go one by one in the detail what is cash, flow and the statement. The cash means cash and the cash equivalents, means the cash in which you are doing the transactions, means the money, means the fund. So, the cash is known as the money. Cash equivalent means the things which you can use in place of the cash, in place of the money. Means what? Means you can use the check, the money which you have put into the bank, you can use instead of using cash. Instead of withdrawing the money, sometimes we are using the online payments, sometimes we are drawing the checks. So, it is known as the cash equivalents. Apart from the bank, this checks and the bank, we are also using the marketable securities. Not all the securities, some securities we are using, and we these things known as the cash equivalent. Means there are three things which comes under the cash equivalent. The very first thing is cash, second one is bank and the third one is your marketable securities. These things can be used in place of using cash. So, the cash means cash or cash equivalent. Now, we will talk about the flow. See, once the money is coming into the business, it is inflows, means money is coming to the business, it is inflowing. And once you are paying something, once you are making the payment to somebody, that times your money is going outside. Maybe you are purchasing something and at the time of purchase, you are giving money to the other person to whom you are purchasing, to the seller. So, it is a flow. Flow means what? Inflows and the outflow. Inflow means once money is coming inside the business, money which entering into the business. And the second one is entering into the business. Second part is the outflow. Outflow means the money which is going out, means you are making payment. While making the payment to the other party, that money is going from your part to the other person's account. Third term which is here, that is a statement, means once you are compiling all these things together, means once you are representing these things to somebody else, means you are giving a format, means you are giving a proper formal format to the all the expenses, all the incomes and all the inflows and outflows, all the cash and cash equivalent, that is known as the statement. Means you are representing it, it is a way to present for the presentation. Once you are presenting it to the other person, to make it understand to the other one, so that other people can get an idea about your inflows and about your outflows, about your cash and about your cash equivalent, that time it become the statement. So, the cash flow statements is talking about that. The cash, they are talking about cash flows, means whether the cash is coming into the business or it is going out of your business. It is known as the cash flow statement. So, formally definition says that it is a statement showing the changes of financial position of the business concern during the interval of time in terms of the cash and cash equivalent. See, in this definition, I can break this definition for better understanding in three parts. One is change in the financial position. What is the change in the financial position? Financial position means whether you are in profit or in you are in loss, and how you calculate this profit and loss means you having your statements like your P&L account, your balance sheet with you, and once you are preparing the cash flow statement, you are checking the financial position of the company, means you having net profit or not. We see that how much profit you have earned last year and how much profit is there is in this year, means you are checking the difference between 2 years, and this change may be positive and this change may be negative. Once it is negative, it is known as the loss, and once it is positive, it is known as the profit. So, we check that whether the company is in good financial position or not. Second, they are talking about the different intervals of the time. Different intervals means they are not preparing on the daily basis, on the monthly basis or on the 6 months basis, but the things which we are recording, it is on the yearly basis. We are making the cash flow statement according to the balance sheet, and balance sheet is always prepared once in a year, that is we prepare for the 31st March, and for 2020, suppose for the last year we are preparing, if we are preparing for the last year, then it will be prepared in the 31st March 2021. So, this is the duration for 12 months, and in this duration of 12 months you are considering all the direct and indirect expenses and all the operating expenses also, you are considering everything. By preparing the balance sheet, you will get an idea about this company's financial position, and you are maintaining the time also. The third one is talking about, we are talking about in terms of the cash and the cash equivalent. Cash, I just told you, we can include in the cash like the liquid cash which is in your hand, cash in hand, cash which you are carrying in the kept in the bank, and your marketable securities. This is your cash equivalent, and the cash, only cash is just cash. But once we are talking about the cash equivalent, these are the three things which comes under the head of cash equivalent, means in place of the cash we can use these things also. So, the definition has given like there is a change in the financial position, the statement which is showing the change in the financial position of the company, and it is concerned with the different time interval we are considering, and we are taking the cash, it should be in terms of only in cash and the cash equivalent. Apart from the cash and cash equivalent, we are not taking anything else. The revised accounting standard 3 has been revised, has made the mandatory for all listed company. The company who are listed, they are supposed to prepare and present the cash flow statement. By presenting the cash flow statement, they are actually showing that how the cash is coming into the business and how the cash is going out of the business, means they are showing the inflow as well as outflow of cash, and cash flow along with the financial statement on annual basis. What other statement we are presenting? We are presenting the trading and P&L account and balance sheet. Along with this trading P&L balance sheet, we are also supposed to prepare the cash flow statement as per the revised accounting standard 3. So, now we will talk about in detail that what is cash flows and what is cash equivalent. The very first thing is that cash flows are inflow and outflow of cash and cash equivalent. Inflow, what are the different things? Think about it, that what are the different items by which the cash is inflowing into the business. What are those things? Means we are making sale. Once you are selling something, means cash is coming into the business. Once you are purchasing something, means your cash is going out of your business. So, you are supposed to consider all the inflows and the outflows for the cash and cash equivalent. It implies movement in the and movement out of the cash and cash equivalent. How the cash flow is, how cash is moving. It is moving inside the business, it is moving outside the business. We need to know about these movement also. Receipt of the cash from non-cash items. In terms of cash inflows, actually whatever cash we are getting out of the selling, out of the doing anything by which the cash is coming into the business, that is considered all the receipts. It is means with the receiving, the money which you are receiving, that is known as the cash inflows. While cash payments, whatever things you are making the payment, you are purchasing something, and for the purchasing anything, you need to pay the money. For the once you are paying, making the payment, it is understood by the cash outflow. I think it is clear to you all. I just repeat it once again, cash inflow and cash outflow. Once you are purchasing something, means once you are doing the purchase, means you are paying it. Once you are making the payment, your money is going out of the business, it is cash outflow. But once you are selling something, it means your money is coming into the business and you are selling the goods or commodity, whatever you are selling, that thing is going out of the business. So, that is inflow of the cash. We need to know, we need to understand the flow of cash only. We are not talking about here the flow of goods and services. Here we are talking about the only cash, by which the cash is coming into the business and by which activities cash is going out of the business. We will talk about only the inflows and outflows of only cash, not about the services, commodities and the goods. Next point, talking about it comprises the cash in hand, demand deposits with the bank. So, these are the things apart from the cash bank. You can consider these things as a cash. Cash means cash and demand deposit which you have kept into with the bank. What are the cash equivalent? This is the short term highly liquid investment. Short term means for the 3 months only, not more than for the 3 months, that will be considered as the cash equivalent, that are readily convertible into known amount of the cash and which are subjected to the insignificant risk of the change in values. So, what is the meaning of cash equivalent? We will consider only the short term investment only for the which are made only for 3 months, that is for the very short period. Second, cash with the bank and your marketable securities which having the less risk. Marketable securities. Okay. So, moving further, what are the objective for preparation of why do we need to prepare the cash flow statement? The very first thing is useful for the short term financial planning. By this actually you are getting an idea about two things. One is your inflows and the second one is your outflows. Once these two things are clear, that time the short term financing planning you can do, means you would be knowing about that how much cash you having and how much payment you want to make. So, it would be giving you a clear picture about the financial position. You can make the short term planning. Useful in efficient cash management. Once you are knowing about the cash inflows and outflows, means if irrelevantly cash is outflowing, so you can put a brake on that place and you can actually stop this outflow also. The necessary things which is need to be done in the business, that will be completed only, other things will be stopped for the time being. Helpful in the formation of business policy, means how your business is developing. You can actually formulate the different strategy for inflows, for increasing your inflows and for decreasing your outflows. Assess the preparation of cash budget. What is the cash budget? In this cash budget, we consider all the receipts and all the payments. Receipts and payment. These receipts are done by the means money inflow or cash inflow, and this payment makes the money outflow, money or cash outflow. So, you can actually by this cash flow statement, you having an idea, you having a clear picture in the format of a statement that what is the inflows you having and what are the different outflows. For the use of the assessment of cash inflow from the various activities, actually once we are preparing the cash flow statement, we consider 3 activities. Only on basis of these 3 activities, it is just similar as, just recall about it, that once you are preparing the trading account, P&L account and the balance sheet, the distribution of the expenses was depend upon their use, means the direct expenses were being transferred to the trading account, indirect expenses were transferred to the P&L account, and other your assets, liability and capital has been transferred to the balance sheet. On the similar format, means what? On the same criteria, like you have identified the nature. Similarly, we have identified 3 activities here. One is operating activity, second is investing activity, and third one is your financing activity. What is the operating activity and investing in financing? See, operating activities means for the activities for to complete the day to day operations. Suppose you are supposed to make, you are into the manufacturing, you are preparing some goods. For making these goods, for making these particular service, what kind of expenses are there, what kind of money requirement is there, that is come to the operating activities. Investing activities, you are investing your money. How you are investing your money? Maybe you are making some investment, long term investment, and maybe what you are doing, you are purchasing the asset, you are investing into the asset, you are increasing your assets, fixed asset. So, by this we are investing the money. Third one is financing activity. Financing activities means from where you are getting the money. There are only two ways to raise the money from the other person. One is you can raise money through bank loan, and sometime you are borrowing money through the equity. You are actually you are asking money from the public, equity or preference shares, or maybe second one is your debentures. You are issuing the debentures and you are asking money from the public. So, there are two major financing activities we can divide, like you can take the money from the loan and that time you are supposed to pay the interest, EMI also. And the second one is you are raising the money through the equity and preference share, and these shares are being issued to the public, and maybe you are issuing the debentures. So, by issuing the debentures, you can raise the money from the public. Moving further, these are the limitation of the cash flow statement. The very first one is, it is based on the historical cost principle. Historical cost principle means you actually consider only the amount, only the money on which you have actually purchased the commodity or purchased the any asset. It is based on the secondary data. Why it is secondary data? Because we are preparing for preparation of the cash flow statement, you are taking the help of the P&L account and the balance sheet. So, the data is already being published and you are using that published data, and on this data your cash flow statement is based. Whatever information has been given to you by the company, only on that basis you can prepare the cash flow statement. There would not be any input from your side, there would be only analysis of the statement, and the analysis of the statement for which kind of a statement, which are already being given to you. No adherence on basis of accounting principles. Cash flow statement is not the substitute for income statement. It is totally different from the income statement. You cannot replace. Once, maybe sometime there would be confusion in terms of the income or cash. Cash is different and the income is different. In the cash you are checking the inflow and outflow. In the income you are taking the only that what income company is having. So, these cannot be replaced with each other. They are not substitute of each other. These were the limitation. Now, we will talk about the classification of business activities as per the accounting standard 3, that is revised. It required that the change resulting in the inflows and outflows of cash and cash equivalent will be classified into the 3 activities. The very first one is operating activities, that is cash flow from operating activities, cash flow from the investing activity. I just told you that what is the operating activities, the cash which is coming from the operating activities by day to day transactions, what cash is coming to the business. Second is cash flow from the investing activities. By the investment, what maybe you are making the long term investment, maybe you are purchasing the new machinery, fixed asset. So, these are the cash flow from the investing activity. The third one is cash flow from the financing activity. By this financing activity, maybe you are raising the fund through the loan. I am writing it here again. You are raising the loan, or maybe you are raising the money through the equity or preference shares, or maybe by the debentures. So, and in investing activity, maybe you are making the long term investment and maybe what you are doing, maybe you are purchasing the fixed asset. And in operating activity, what we are doing day to day expenses and flows, flow of cash. So, moving further, the cash flow, now we will go in detail one by one. The cash of activities are the principal revenue producing activities of the enterprise and other activities that are non-investing on financing. Investing activities are those activities in which you are making, means you are purchasing the asset, or maybe you are doing the investment. Apart from this investment, the money from which you are, the amount which you are raising from the other parties, maybe through the equity share, maybe through the preference share and debentures, maybe through the bank loan. Apart from these two activities, whatever things are being happening into the business, that comes under the operating activities for producing the commodity. So, there is a classification for the operating activities. The very first one we have divided like cash inflows and the cash outflows. How the cash is coming in, cash inflows is being done in the cash sales, cash received from the debtors, cash received from commission or fees, and any royalty if it is there. And cash outflows are cash purchase, payment of creditors, cash operating expenses, payment of wages and income tax if you have paid. These all are the operating cash outflows. If we are moving for the finance company, it is in journal. For the finance company, cash received from interest and dividend. If any financing company is receiving the interest and receiving the dividend, that will come into the inflow, cash inflows, and sale of security. If you have sold any kind of securities, that again cash will come into the business. Cash paid to for the interest and purchase of any security. Here we are purchasing the security, selling the security, that will be your cash inflow, and once you are making the purchase of security, that will go to the cash outflows. Similarly, once you are receiving the interest and dividend, that will your cash inflow, and if you are paying it, that will be your cash outflow. If we talk about any insurance company, the premiums and the claims which have been received will come to the inflow, and the premium and claims which you have paid, that will go to the outflow. If we talk about the real estate or infrastructure company, that is the rent which you have received, that will be inflow, and with the rent which you have paid, that will be your outflow. See, similar kind of expenses, one time it is investment, one time it is your at cash receivable or cash inflows, and one time it is on cash outflow. It just depends upon the different different activity. Means once you are purchasing anything, it means you are supposed to pay. Once you are selling something, it means you are supposed to receive the money. If we make it more simple, once you are receiving anything, whether it is interest, whether it is commission, whether it is rent, whether it is income, whether it is dividend, it is all cash inflow. But once you are paying all these things, means once you are paying dividend, once you are paying interest, once you are paying rent, once you are paying the your premiums and claims, all these things are cash outflows. Now, we will talk about the investing activities. Cash flows from investing activities as per the accounting standard. Investing activities are the acquisition and disposal of long term assets, other investment not including the cash equivalent. Here we do not consider the cash equivalent, we will talk about only the long term investment and the fixed assets. Cash flow investing activities can be exhibit like, this is the example, the classification of the investing activities. Again the which are the cash flow and which are the cash outflows. Once you are selling the fixed asset, selling any investment, you are receiving interest and you are receiving dividend or rent, it is cash inflow. Once you are making the purchase, and once you are purchasing any investment or you are taking any investment, you are doing any investment, in this your money is going out of your hand. that is the inflows and outflows in investing activity. See, once we are talking about the investing activity, we will always talk about the assets and the fixed asset and always talk about the long term investments. The third activity is your financing activity. Financing activities are the activities which are result in change of the size of the composition of the owner's capital, including preference share capital, borrowing including debentures. See, it is always being assumed that once you are raising money through other people, means you are raising preference shares and you are raising the debentures. So, once you are raising the money, suppose you are making your capital and your capital has been having the formation of preference shares, that is your it will be called like it is owner's capital. And once you are making your capital by the debentures, it will be like you are taking it from the external sources. Sometimes we call the composition of the equity, preference share and the debentures, we call the internal equities and the external equities. Your debentures is a form of loan, that is always being known as the external equities, but your shares are assumed to be your internal equities. This is the classification of the financing activities. This is how we are the cash flow inflow is there and cash outflow is there. How the cash inflow is being done, that once you are issuing the shares in cash, means once you are issuing your share, people are purchasing your share. Once the other people are purchasing, they are sending you money, they are paying you money. Once you are receiving the money, it is your inflow. Issue of debentures in cash, again the same thing is there. You are issuing the debenture, the people are paying you, the money is inflowing, inflow is there. Proceed from long term borrowing, securities, premium received, increase in balance of bank, overdraft and cash credit accounts. By these your all the incomes are coming, this is your inflows. And just opposite to this, once you are paying the loan, redemption of preference share or debentures. Redemption is what? Once you are making the full and final payment to the preference shareholders and the debenture holder, that time it is known as the redemption. Buyback of equity share. Buyback means what? Once you have sold your equity share is already allocated to somebody, to yourself, maybe to yourself, but you are buying it back, you are taking it again, and this by purchasing it again, it means what you are doing, that cash is outflowing. Payment of dividend, payment of interest, premium paid to the redemption of preference share and debentures. Sometime it is happening that sometime we are issuing the debentures or this preference shares on discount, and sometime we are issuing them on the premium. Discount means what? If suppose the amount from the share is 100 and if you are saying that we are issuing it on discount, means maybe you are charging less. So, if at par the cost, if at par cost is 100 rupees for per share, discount will be like, suppose you are charging only 95, means for 5 rupees you have given the discount. The person who have taken your shares, who have purchased your share or debentures, he has to pay 5 rupees less for a single share. Similarly, once you are saying that we are issuing it on premium basis, premium means that you are charging high. Suppose 100 rupees your at par charges, and if you are charging 110, if you are charging 110 means anybody who is interested in to purchase your shares, purchase your debenture, they have to pay 10 rupees extra for per share, that is known as the premium. Similarly, it is happening for the premium paid for the redemption. For purchasing it is also happening, for the redemption it is also happening. Once you are doing it for the redemption time, it is known as the cash outflow, because that time it is a loss for the company, means you are paying high to them, they are not paying you high, but you are paying high, means what? 100 for the 100 rupees share you are paying it 110 rupees, charge 110 rupees for the same share which he has purchased in 100 rupees, means 10 rupees you are paying extra. Decrease in balance of bank overdraft and the cash credit accounts. So, these are the activities, cash inflows and the cash outflows. So, in short we can say, if we prepare the, see here is the P&L account, it would be easy for you to understand that how to remember this. Suppose it is a P&L account, amount will be there in rupees, it is in the T vertical format. This is your balance sheet. The indirect, you are you are adding all the indirect expenses here and all indirect incomes here. Similarly, you are actually, what you are doing in the beginning of the balance sheet, preparing of the balance sheet, what we are doing, capital is being here written here, like capital, your shares, maybe equity, maybe preference shares, maybe debentures, bank loan, your current liabilities. If we talk about your assets, so fixed asset, I am just writing the head of this, not in the detail, and your current assets. See, current assets and current liabilities always known as the operating activities item. Why operating activities item? Because they help in the day to day operation. But this is what once you are raising the money, it is known as your financing activity. All these things, all these expenses also will consider in the operating activities, because these are the expenses which which actually been arise during the process of the operation or activity for generating the profit. So, these will come to the operating activities. Your fixed asset and your investment, long term investment, will go to the investing activity. I think it is clear to you to understand that part of the P&L account, that is, it will consider in operating activity. So, this is the format, we will talk about in the format in detail once we will solve the question. This is again the component of the cash flow statement. This is the operations activity, this is investing activity and financing activity, not going in the detail because I just explained all these things to you. These are the reference from where I have taken this content. You can use these books, by this you can actually get an idea about the detail of cash inflow and cash outflows, operating, financing and other activities. With this, thank you so much.